Have you ever opened your bank app, seen a few extra bucks labeled interest, and thought, nice, free money? But wait, what if that little gift comes with a hidden cost? Imagine getting a letter from the IRS, all because of a $12 gain you completely forgot about. Sounds crazy, right? But it happens every year. And the reason is so simple. Most people overlook it until it's too late. So let's talk about something no one really warns you about until it bites. Do you have to pay taxes on that small interest your bank pays you? Stick around because this answer is trickier than you think. And what you don't know might just land you in hot water with Uncle Sam. Number 1. What is bank interest and why should you care? Let's start with the basics. Bank interest is the small reward your bank gives you just for keeping your money parked in their account. It's like your dollars are working the night shift while you sleep. Sounds nice, right? Let's say you have $5,000 sitting in a savings account that earns 1% interest per year. That's $50 in interest just for doing nothing. It may not sound like much, but here's the catch. The IRS sees that $50 exactly the same. Way it sees your paycheck? Yup, it's considered income. And where there's income, you guessed it, there's usually tax. Number 2, is that tiny interest really taxable? Absolutely. It's one of the most overlooked forms of income for beginners. Just because the bank quietly drops a few extra dollars into your account doesn't mean it's off the radar. Even if you only earned $3 in interest last year, you're technically required to report it. The IRS doesn't care if it's big or small. To them, income is income. So what happens if you don't report it? Well, let's just say the IRS has a pretty good memory. Number 3. How does the IRS even know about it? Here's the twist here. Bank tells them, if you earn more than $10 in interest from a bank account in a single year, the bank is required to send a form called a 1099-IND to both you and the IRS. So even if you forget, the IRS won't. Let that sink in. You could forget to report $11, but they won't. And when your numbers don't match up with what your bank reported, you might receive a letter in the mail you definitely didn't expect called a CP2 new notice. Translation. They caught it, and now you owe extra tax, maybe a penalty, and possibly interest on top of it. Yes, interest on your interest. Ironic, right? Number 4. What if I didn't get a form? Let's say you earned only $7 in interest, and your bank never sent you a 1099-IND form. You're off the hook, right? Wrong, you still owe taxes on it. Just because your bank didn't send the form doesn't mean it's tax-free. You're still legally required to report any interest income, no matter how small. This is one of the most common traps people fall into. So always check your year-end bank statement. Look for that total interest earned. Don't just rely on forms in the mail. Number 5. Where do you even report interest on your taxes? If you're using a standard 1040 tax return, there's a section for interest income. Pretty straightforward. Most tax software will walk you through it automatically and even ask which banks paid you interest. Let's say you earned $15 in interest from Wells Fargo and another $12 from Capital One. You'll report $27 in total and name the banks you earned it from. It's not hard, but it's easy to forget if you don't keep track. Number 6. What about kids' accounts? Here's a fun one. Your kid has a savings account. Maybe grandma gave them a few $100 and it's been slowly growing. Guess. What? The IRS wants a cut from your kid too. If a child earns more than $1,250 in unearned income, like interest, they might need to file their own tax return. And if it's high enough, it could fall under the kiddie tax, which is taxed at the parent's rate. So if you thought setting up a savings account for your little one was totally harmless, it mostly is. But once the interest hits a certain level, the tax man starts paying attention. Number 7. What if you share the account with someone? Joint accounts can complicate things. If you share an account with your spouse or another person, the IRS generally expects you to split the interest income 50-50 unless you have proof of a different arrangement. So if a joint account earns $80 in interest, each person usually reports $40. Just make sure you don't both accidentally report the full $80. That's a red flag. And yes, the IRS notices mismatches like that too. Number 8. Can you avoid these taxes? Here's where it gets strategic. You can't just skip paying taxes on interest, but you can shift where your money grows. Consider a Roth IRA. It's a retirement account where your interest grows tax-free. You follow the rules. Or look into municipal bonds, which often pay interest that's exempt from federal tax. Another option, a health savings account, if you're eligible for one. The interest or investment growth inside it is tax-free as long as you use the money for qualified medical expenses. So no, not all interest is taxed. But your standard checking and savings accounts? Those definitely are. Number 9. Why this matters more now than before 4 years. Interest rates were so low, no one cared. You'd earn 27 cents in a whole year. It was laughable. But now, interest rates have gone up. Some online banks are offering 4% or even more. That means if you've got $10,000 in a savings account, you might earn $400 in a year. That's real money and real taxes. As rates rise, more people are unknowingly creating tax obligations they never had before. Number 10. How? To keep track without losing your mind, you don't need a spreadsheet the size of Texas. Just check your monthly or quarterly bank statements. Most banks show a year-to-date interest total at the bottom. You can also use personal finance apps like Mint, or you need a budget. They track every penny of your income, including interest, and make it easy to find at tax time. Better yet, a calendar reminder in January every year to check your statements and grab your 1099. This one habit can save you from tax headaches down the road. Number 11. What if you totally forgot to report it? If you catch the mistake before the IRS does, you can file an amended return. It's not fun, but it's a lot better than waiting for that dreaded CP 2000 letter. But if you wait and the IRS catches it first, you'll likely owe not just the tax, but interest and a possible penalty too. The sooner you fix it, the cheaper it will be. Number 12. Does this apply to online banks? 2. Yes. Whether you bank with Chase, Wells Fargo, or some online-only place like Ally or Discover, the rules are exactly the same. In fact, online banks often pay higher interest, so you might earn more and owe more. But don't worry, most of them also make it super easy to download your tax forms electronically, which makes filing much simpler. Number 13. Should you be afraid of this? Not at all. It's not scary if you're aware of it. Key is just knowing what to expect and how to report it. Think of it like brushing your teeth. It takes 2 minutes, but skipping it too many times, yeah, you'll feel the pain later. Same goes for your taxes. Few minutes in January can save you hours and hundreds of dollars come April. Number 14, the bigger picture understanding. How taxes work on something as small as bank interest trains your brain to pay attention. And that's powerful, because once you're tuned into how money flows, from your bank account to your taxes, you're ready to take control of your finances in a whole new way. And hey, if you're earning enough interest to owe taxes, that probably means you're doing something right. You're saving, you're growing. Now it's just time to get a little smarter with how you report it. So next time, your bank adds $10 to your account and calls it interest. Don't ignore it. Track it. Understand it. Own it. Have you ever been surprised by a tax rule you didn't know about like this one? Share your story in the comments. You never know who else you might help by telling it.